If you're very, very good and aggressive with using the legalities of the tax code, you can pay far less as an independent contractor income taxes than you would pay as a W-2 employee. And this is just because our tax code, for whatever reason, penalizes earned income. If you're a high-paid W-2 employee, you're going to pay the highest tax rates. If you work overtime, you're getting taxed through the nose. It's just the way our tax code is set up, unfortunately. Hi, tax patients. I'm Eric Wright. I'm a physician and founder of 1099 Tax Doctor, and today we're going to briefly talk about the differences between being a W-2 employee and being a 1099 independent contractor. A lot of physicians are very familiar with being an employee, obviously, but in the field of medicine, as in other white-collar fields, you have the chance to be treated as a 1099 a lot of the times, and that can be kind of daunting for some people because there's tax implications, and it's just a kind of an unfamiliar concept. So let's talk about the difference. Let's say you have a business and you want someone to do work for your business. So you have the option of hiring somebody directly as an employee. And if they're your employee, you're going to pay them a salary. You're going to withhold all of their income taxes and payroll taxes, Medicare and Social Security from their salary. At the end of the year, you're going to give them a W-2, which specifies how much you paid them and how much tax was withheld from their salary. You also can hire somebody directly like a business. Let's say you want to hire a plumber. You're not going to hire on a plumber as an employee for your house, right? You just need your toilet unclogged. So you're going to hire a plumber. He might have a business that's set up as an LLC, or it might just be him. It might just be him as a single sole proprietor, and you hire Mike the plumber and you pay him. And if someone does recurring work for you on kind of an ongoing basis, you're going to call them an independent contractor. And at the end of the year, you're going to give them a tax form 1099, which specifies how much money you paid them. The difference is that as a 1099, you don't have taxes withheld from the money that you're paid. So when you give someone a 1099 as a contractor, you're not withholding tax funds. They're responsible for tracking and paying their taxes. So you have these two options, being an employee or an independent contractor. The benefits, and the tax law specifies basically in the federal and state tax law when you have to treat someone as an employee versus when you're allowed to treat them as a contractor. White-collar professionals like physicians tend to have a much greater latitude to be treated as contractors for the purposes of tax law as well. So let's talk about some of the tax implications of being a W-2 versus a 1099. Overall, if you're very, very good and aggressive with using the legalities of the tax code, you can pay far less as an independent contractor in income taxes than you would pay as a W-2 employee. And this is just because our tax code, for whatever reason, penalizes earned income. If you're a high-paid W-2 employee, you're going to pay the highest tax rates. If you work overtime, you're getting taxed through the nose. It's just the way our tax code is set up, unfortunately. But the benefits of being a W-2 employee is that it's really easy. You're going to pay the highest tax you can probably possibly pay being structured as a W-2 employee, but it is easy. You don't have to worry about your taxes. They are taken out of your paycheck, calculated and paid for you. You typically don't have to worry about benefits because most of the time, if you're a full-time employee, your employer is arranging for health insurance and a retirement plan. So that's just kind of set up and done for you. So you don't really have to worry about anything. The downside, obviously, is that you don't have any choice. You're going to pay the highest tax rate. You're going to take whatever health plan they give you. You're going to take whatever probably meager retirement benefits that they give you. And there's really no way to shelter W-2 income. You know, a state 529 can shelter a little bit from state, but not federal taxes. Charitable contributions lower your taxable income, but there's really no way for you to shelter W-2 income. We won't get into the intricacies of real estate and short-term rental loopholes and rep status right now, because if you're doing that stuff to save $20,000 or $30,000 on income taxes, to me, that's just a little difficult and over the top. But so really in general, there's just not much you can do with W-2 income. On the contrary, with 1099, there's a lot you can do. Now, up front, the downsides is that you have to calculate and pay taxes yourself. Whoever's giving you your 1099, they're not doing it. So you have to kind of get an idea of how much to pay as a quarterly estimated tax payment and kind of track that and do that yourself. You have to arrange for your own health insurance, which usually means going through the state marketplace, healthcare.gov, and buying an Obamacare plan off the state marketplace. And you set up your own retirement accounts, like a SEP IRA or a solo 401k or a cash balance plan. So you have to kind of do all that stuff yourself. The upside is that specifically with regards to retirement benefits, they are fantastically better as a 1099 than as a W-2 employee. So you can shelter hundreds of thousands of dollars of your earned income, of your revenue as a 1099 in tax-deferred retirement accounts, and essentially transfer a lot of your tax burden from 30 to 40% plus effective tax rate into retirement, which is then not subject to capital gains taxes, and then only pay tax at retirement when you're almost certainly going to be in a much lower tax bracket overall. So that's one of the big benefits of being a 1099. Specifically, a solo 401k goes up to $71,000 for this tax year. There's something called a defined benefit plan, otherwise sometimes called a cash balance plan. Those plans can allow you, based upon some certain factors, to get $200,000, $300,000, $400,000 a year of your 1099 revenue into that plan and divert it away from paying a high tax rate on it. And then there's, business expenses, and we won't get into the intricacies of all this either. We don't have time, keep this nice and brief, but you can write off a home office. You can potentially deduct a portion of your vehicle. You can deduct travel when it's for work purposes, meetings, meals, equipment, electronics, things that you use to run your business can be, written off against your business revenue. And that can be a significant deduction that saves a lot in taxes. So that's why it's really important to be aggressive if you're a 1099 in terms of setting up, whether or not it's an LLC with an S Corp for self-employment tax savings, whether it's a solo 401k and layering that with a cash balance plan, using those contributions to get the 199A or the QBI deduction. All these concepts are really important to understand and implement effectively when you're a 1099, because it can seriously, as a practicing physician, drop your annual tax bill $40, $50, $60 plus $1,000 fairly easily and for a fairly low cost. This is the kind of thing a 1099 tax doctor does. This is what I started it for physicians to implement these exact tax strategies using the people that I myself use, because this is exactly what I do. I'm a 1099 physician. And yeah, if you have any questions, feel free to reach out. Thanks for listening.
You've been listening to the 1099 Tax Doctor podcast. Dr. Eric Wright isn't just talking about 1099 income, he lives it. As a physician and independent contractor, he's learned how to make the tax system work for him and for his colleagues. Learn more about how Dr. Eric Wright helps physicians keep more of their hard-earned income by visiting 1099taxdoctor.com. This podcast is educational only and not personalized tax, legal, or financial advice. We're here to talk strategy, not write prescriptions. Always consult your own licensed professional before making decisions about your own financial situation.